Good morning, everybody, and welcome to this Thursday, August 24th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. Interesting day as we look ahead. Right now, we've got some bifurcated futures. Dow futures are down about 44 points. S&P 500 futures up 19, almost 20 points. And the NASDAQ futures up almost 150 points. Crude oil down roughly about 1/3 of 1%. And that US 10-year Treasury yield sitting at 4.23%, still below that 4.33, 4.34 level, where we are looking to see if we can get a breakout. Not that we really necessarily want one, but that's a really big level that we want to watch, especially going into the Jackson Hole speech tomorrow by Fed Chief Powell. We'll see whether or not anything is said there that sheds more light on what the Fed is likely to do, and that obviously could have a big impact on both the bond and the stock markets. But right now we're sitting at 4.23%. We are up about 3 basis points this morning. A couple of economic reports out we'll talk about in just a minute. But the big news from last night, NVIDIA absolutely blew their earnings away. I was a little nervous about NVIDIA just because it didn't set up quite as bullishly going into the earnings as it had in the previous quarter, but it didn't matter. Honestly, it was just a knock the cover off the ball, kind of a home run last night from NVIDIA. Their earnings were expected to come in at $2.09. They came in at $2.70. That's a pretty big beat. And we had some other companies reporting. We'll talk about all these various companies and take a look at what they're doing in pre-market action a little bit later in the show. But there were some pretty big earnings reports out of Snowflake, Autodesk, Easy Beat on the bottom line. Splunk crushed their bottom line. But we'll take a look at the reactions to some of those later in the show. Well, let me go ahead and take a look first at some of the things that happened yesterday. Take a little different view today. So I just want to go through and just point out basically all of our major indices were higher yesterday. You can see starting off with the Dow there, but there was a little bit of disparity in terms of how much these various areas were up. For instance, the NASDAQ yesterday led. That's like, this week the NASDAQ is certainly putting on a performance, not just in absolute terms, but also relative terms to some of the other major indices. So the Dow was up 0.54%. The S&P 500 up 1.1%. The NASDAQ up 1.6%. Then we had small caps, which had been lagging earlier, did come on a little bit later. Gained over 1%, about the same as the S&P 500. And then the mid cap, right in that same range as well. We saw the VIX tumble a little bit, down about 6%, dropping back down below 16. I still think we have one more hurdle here in the short term, and that is what happens with the Fed tomorrow from Jackson Hole. I'm not going to predict. I mean, I don't know what Fed Chief Powell is going to say. I don't know what path they're looking at. I can only say that I believe from history that the Fed would like to see the stock market go down. I think that's just one thing to kind of help slow the economy. The stock market is one of the top leading indicators of our economy. And so if the stock market were to fall a little bit, if they put out a little bit more interest rate fears, thinking maybe that would spark a sell-off. I don't know. I'm just kind of guessing up here, but we're gonna all find out together tomorrow what they say, what he says, and then how the market reacts to it. It could be fireworks tomorrow, though, so at least be prepared. It would be one of those days. If I was an active trader, I wouldn't want to be away from my computer. Let me just say it that way. Sectors. Let's go ahead and talk a little bit about the sectors. So look at the top two groups: technology, communication services. We got another lift from internet stocks. If you pull up technology group, you'll see semiconductors up there again at the top. That was prior to the NVIDIA numbers. I mean, we should see a pretty good start to the day from NVIDIA and also from the semiconductor group as a whole. But renewable energy was up, computer hardware, software. I mean, this was an across the board move in the technology area. If we look at the communication services group, media agencies, internet, both up more than 2%, close to 2.5%. Publishers up 1%. Again, very strong across the board type of move. Moving on to the 10-year Treasury yield. So there has been actually a couple economic reports out this morning. First, let's start off with the initial jobless claims. 230,000 was the actual number. The estimate was for 241,000. So again, that kind of gets to my point where the economy is still humming along pretty strong. And I don't know how much that's going to impact what the Fed has to say tomorrow. Last week, initial jobless claims were 240,000. So not only did we come in 11,000 below expectation, but we came in 10,000 below last week's number. So again, not really showing any major signs of economic weakness or any kind of deterioration, really. And that may have the Fed a little bit nervous. I don't know. July durable goods came out this morning, minus 5.2% versus an estimate of minus 4%. Now, before you start running for the exits in the market, you have to understand durable goods is an extremely volatile number. And a lot of times when you strip out the transports, it can kind of go back to normal. And that was kind of the case this week. So again, today's July durable goods number came in minus 5.2%, estimate minus 4.0. Last month, though, for June, the number was positive 4.4%. So I think it's, pretty clear that this number can jump. And I always talk about maybe using 3-month or even a 6-month moving average on durable goods because they do flip-flop every month, it seems. And so I don't know that you get a really good reading on exactly what's going on with durable goods just by looking at it month to month. I think you really need to take it in context of a longer period. If we strip out the transports for July, durable goods actually rose 0.5%. And the estimate was only 0.2%. So again, the transports can have a really big impact on these numbers, and they did certainly for the month of July. Looking at that 10-year Treasury yield, let me get the latest here. So we did jump up, had a really rough day yesterday in terms of the yield. Actually, that means whenever the yield's coming down, means Treasury prices are going up. So the bonds were being bought yesterday. Normally, if you think, inflation could be a problem, you're worried about the Fed, normally you would sell bonds and yields would go up. In this case, we actually saw the yields coming back down. As I've said, I'm kind of looking right now between 415 and 420 as short-term support on the yield. Here was that breakout above 420, and we're coming back down testing that. And then you've got the rising 20-day moving average, which if you look back over the past few months, generally is held. We've seen a few days below the 20, but for the most part, it's been trending higher, holding the 20-day. The 20-day has been above the 50-day. And so we've got a short-term uptrend that is in play. So normally you would assume it will continue until it doesn't. I don't know what's going to happen with the Fed tomorrow, but I think this could be impacted quite a bit. As far as yield resistance goes, you look back to the October 2022 high, 4.33%. You look at what we just saw earlier this week and last week, above 430, as high as about 436. Actually, let me give you that number. It's 436 or 437. 4.362. So 436 was the intraday high. The closes came in at 433 there. And then back on last Friday, we had a close of 434. And the high candle body, the open from back in October 2022, the high was 433. So that 433, 434 is kind of a big deal. And some would say, hey, we had an uptrend and this is like a lengthy cup. Yeah, I mean, I can see that. Let's take a look. Let's go out a little bit further here. So this is what we're talking about. In order to have a continuation pattern, you have to have a prior trend. You can't continue something if you don't have a prior trend. So anytime you look at cup and handle, head and shoulders, anything, like that, an ascending triangle, you need to have a prior trend to either extend a continuation, or in the case of a head and shoulders, that could be a reversing pattern. But you have to have a prior trend to reverse or a prior trend to continue. So here you clearly got an uptrend. This is a lengthy cup, but it's a pretty symmetrical one. I think most traders, anybody looking at charts going back a couple of years, could probably spot this as a cup. Does that mean we're going to have a handle and then we're going to have a breakout? Well, that's the likely result. It's not a guarantee, but that's what we use technical analysis for, one of the things is to identify these patterns and then to make predictions based on targets. Well, this was at 433 at the top. Down at the bottom, it's at 325. So if we were to go into a little bit of a handle and then make this breakout, potentially we'd be looking at a little bit more than another full percentage point. Well, from 433, if you're talking about another full percentage point, you're talking about 533 as the measurement if we get this breakout. It's kind of a big deal, because I think if we start putting a 5 handle on the 10-year Treasury yield, I do not believe that would be well received by the market. I think that is somewhere around 5%, I think, is kind of a number where you might see a lot of folks bailing out of the stock market and going for the safety of a 10-year Treasury yield. 5% is nothing to, sneeze at. When I talked about the pandemic and I said we were going to come rallying right back, one of the reasons was, where else were you going to go with your money? Back then, the 10-year Treasury yield, if we go back all the way to the beginning of the pandemic, we got down to zero. I think we were down to 0.3, 0.4%. And for the next couple of years, we were still down under 2%. You think money's going to bail out of the stock market to go get a 2% 10-year yield? Just about every 5 or 10-year period in our history, I would probably say every 10-year period in our history, the stock market has outperformed 2%. So it's always this, when you're looking at the bond market and the stock market, it's which one do you want to be in? And as interest rates climb, it's going to be more of a difficult decision about whether you want to stay in the stock market or whether you want to take that locked in 10-year Treasury yield of 5% or 5.25% if we get there. So that's something you got to keep in the back of your mind. Right now we're at 420. I don't think 420 is a problem. But if you're telling me, hey, what are some of the things that would really make you nervous about this bull market? That would be one of them. If interest rates keep climbing and climbing, and the Fed keeps talking about raising and raising, yeah, that I think certainly we're starting to get the levels where we need to be thinking about it. All right, moving on. I wanted to look at the monthly charts this time. So let's go ahead and pull up the S&P 500. I'm going to stretch this chart out so I think it'll show up a little bit better on your screen. All right, so that should look better, I hope. But here is a monthly chart. And when I talk about perspective, I try to get away from daily charts. I mean, weekly certainly better. Monthly kind of gets rid of a lot of noise, all the things that we've been through. I mean, this chart gives us the financial crisis back at the end of 2008, 2009. I mean, we could go back 20 years and really bring a lot into play. This was that secular bear market decline that we had 2007 to early 2009. Here was that period, really rough period we had, consolidating sideways for a long time throughout 2015 into early 2016 before we took off. Here is the 2018 cyclical bear market. That was the trade war. Here's the pandemic. Here's the 2022 cyclical bear market. And if you look at it from a longer term, kind of like outer space coming in, looking at this, it doesn't look that bad, does it? I mean, since 2009, it looks to me like an uptrending chart, staying above the 50-month almost exclusively. I mean, once we got up above it, maybe in 2011, I mean, we had 1 month where we closed below it there. And that's it. We haven't had any other closes. We had some opens, we had some intra-month below, but we had nothing where we closed below the 50-month moving average. Only once, 2011. Since then, 12 years, not one single monthly close below the rising 50-month moving average. If you look back at prior secular bull markets, this is what they look like. Secular bear markets have this tendency to take out that 50 and go much, much further below. I'm seeing secular bull market. Call me crazy, but I think, and I'm seeing a nice cup. I mean, we reset the PPO down near the center line. We're trending higher. The RSI, monthly RSI, did not go below 40. And if you go back, we haven't been below 40 since 2009. Again, RSI 40, no matter what period you're looking at, RSI 40 during an uptrend tends to provide you support. And it did, even on the monthly chart. So again, trying to keep it real. Yeah, the day-to-day, oh my gosh, we went below the 50-day moving average, or we tested the 50-day moving average, we're losing the 20-day. These are all short-term issues. These are not secular bull market versus secular bear market. The monthly is where you see the difference there. And I mean, I could go back 50 years. This is what your secular bear market looks like, the 2000s, all the way to 2000, from 2000 to 2009. And we didn't clear the double top here until 2013. That's when, to me, the secular bull market begins, because you don't know if we're going to fail again and go back down. I mean, here we had a nice little trend higher, but that was not a secular, didn't turn out to be a secular bull market. It was a cyclical bull market within a secular bear. Perspective is really important in the stock market. I never let these monthly charts get away from me. Otherwise, you drive yourself absolutely bonkers with the daily charts, the fluctuations, the pullbacks, the media. You'll never have yourself, your mind, your head on straight. If you're a long-term investor, watch the monthly charts. I mean, when you lose the 50-month moving average, you still have plenty of downside. So give yourself that downside as a long-term investor in order to reap the benefits of a long-term advance. Day trading, short-term trading, swing trading, that's what I like to do, swing trade. Those are all nice, and I enjoy it, and that's kind of my expertise. But from a long-term perspective, again, if you're an investor, keep these monthly charts close. All right, let's take a look at the NDX on this monthly chart. I mean, here was 2000 all the way to 2009. But I mean, when you are in a rise, here it looks like we had a couple of months in 1990 where we went just below. That would have been during the cyclical bear market. That was the Persian Gulf War. But right there, we went just slightly below. But the entire 1990s after that, if you just followed the 50-month moving average, you never get out. You know how many stories were in there? Here was Bernanke's irrational exuberance speech somewhere during 1996. Might have been later in the year. And then we had 4 of the best years in history after that. They don't do very well as stock market prognosticators. And then we went through this secular bear, and then look again. I mean, how many monthly closes do you see on the NASDAQ? It went down more than the S&P 500. Nary one. How about small caps? I mean, small caps, everybody's upset because small caps, haven't performed well. Well, again, it's a lack of perspective. Small caps have been fine long-term. Are they performing as well as the NASDAQ recently? No. And when I say recently, I'm talking about the last few years. We went down, and we have had a couple of closes. Maybe there was one back with the pandemic. And then the cyclical bear market. Here's a case where we went a little bit below the 50-month moving average, but Where was the double top that we broke out from right there? Did we ever go below that price support? The answer is no. And we're trending higher. Are we down, over the past month? Yes. But are we still above the 50? Yes. Do I see the PPO turning up right at the center line? Yes. So again, it comes down to perspective. It comes down to your time frame. But yeah, I'm not giving up on the small caps. Small caps are fine. Again, more recently, last 2 or 3 years, they've underperformed. Well, I'll say the last couple of years, they've underperformed. They actually performed pretty well if you go back into 2020. This was a much stronger move on small caps than it was on the NASDAQ, percentage-wise. Then we pulled back. We probably held up a little bit better on the pullback, but we haven't rallied as much. It's all about perspective. Again, IWM, I think, looks fine. How about transports? These are the 4 I like to show you charts on. I wanted to change it up. I wanted to show you the monthly chart. I mean, should you be overly concerned from a long-term perspective? Those of you out there, if you're in your 20s and you're in your 30s and you're afraid of the stock market, it should be the opposite. You should be afraid of not being in the stock market. And if you've got, if you're older, you're retired, and you've got children and grandchildren that are afraid of the stock market, show them these charts. My gosh, it makes a huge difference over your lifetime to just put your 401k money in here, invest, and let it go. I don't know, how I can show it any clearer. This is 50 years. I mean, yeah, there's 2008, 2009 financial crisis. Here was 1987. Look at that awful crash in transports. It was just horrible, wasn't it? Came right back. There's your 2008, 2009. Came right back. There's your pandemic. Came right back. Parking your money in the US stock market over the long term. Good idea. And I would even say those who are in retirement or about to retire, you don't need all that money right at the beginning of your retirement. I mean, if you have a nice nest egg, make sure you still invest some of it for your later years. I mean, if you're maybe 65 or 70, think about if you live to 90, 20, 25 years that you can have your money continuing to grow, some of it. Again, you're not going to spend it all up front. Don't worry about, I can't predict the future. I don't know. Maybe we're going to go down. Maybe we'll be Japan and we'll go down for 30 years. I don't believe that's the case, but I guess anything is possible. But I do think you're going to miss out if you're got that long-term time frame and you don't invest. I believe you're going to miss out. Anyway, that's enough of that for me. Let's keep moving. I wanted to talk about, still got about 7 minutes before the market opens. I wanted to talk about chart of the day. Always like to do these. If you enjoy these charts of the day when I talk about them, then you make sure you sign up. Monday, Wednesday, and Friday, we deliver to anybody who is subscribed to our EB Digest. We deliver a chart of the day. Go over to earningsbeats.com, scroll down, and make sure you subscribe. And again, if you've got children and grandchildren that don't understand the stock market, have them sign up for our newsletter. I mean, I spend a lot of time doing this, trying to teach a lot of the things that I've learned over the years. I realize there are a lot of folks can't afford our service. This is an area where we try to give back. I don't know why anyone wouldn't want to subscribe to a free newsletter where we talk about a lot of the things that are important in the market. Monday, Wednesday, Friday. That's usually 8:30 in the morning. If it comes out a little later or there's some delay, it's usually my fault. So I'll just apologize in advance. Sometimes things happen. But usually Monday, Wednesday, Friday, we try to get it out around 8:30, maybe between 8:30 and 9. All it takes is a name and an email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. I think it'll help you over time. All right, let's take a look at the chart. So I want to go over Merck. I don't know recently if you saw Eli Lilly, which absolutely blew. Well, I'll pull up the chart. It's a pharma, and there's the earnings, and it was kind of sideways for a little while, and then it just kind of took off. I don't know if Merck's going to do that because it hasn't been as good a performer. You can see it's actually been downtrending, but I do like yesterday's move, the heavier volume, the move back up above the moving averages. And you might say, well, yeah, it did that before and it came down. It started strengthening here and it came down. And, we've just been going sideways. Why is this any different? Well, I don't know that it is, but if we stretch this chart out, again, we're looking at a 1-year chart. What if we looked at a 5-year weekly chart on Merck? Do you see a little different picture here? I think it's clearly in an uptrend. Last 2 years, stock's gone from 70 to 110. It's a pretty good dividend payer. So if you've got that kind of return in terms of capital appreciation, and then you throw their dividend in, pretty nice total return on a stock like Merck. So I see what was a negative divergence, higher price, lower PPO, and this is on a weekly chart. When you have a negative divergence on a daily chart or on an hourly chart, let's start with an hourly chart. If you have a negative divergence on an hourly chart, you might see a test of the 50-period moving average, 50-hour moving average in maybe 1 to 3 days. It could happen really quickly and usually does. If you're looking at a daily chart, I would say maybe 1 to 3 weeks is when a daily negative divergence tends to play out. Maybe a little bit longer, but usually that 1 to 3 week area is what I would look for. When you're looking at, or 1 to 3 weeks. When you're looking at a weekly chart, I actually think 1 to 3 months. And if you notice, when we got up here and set this, is the beginning of May, 1, 2, 3 months, and there we are, resetting the PPO. So the weekly chart, that weekly long-term momentum issue is now gone. Now, what that means to me is if you break below 105, you want to hit the exits, 104, 105, maybe even go down over here, 102, something like that. But I would be expecting now that, we're in an uptrend, the negative divergence played out, I'd be looking for it to go higher. And when you look at this daily chart, that's why this looks a little bit different to me, because this low was actually the low that reset the weekly PPO. Again, it's about perspective. Sometimes you look at a daily chart, doesn't look that great. You look at a weekly chart and all of a sudden you're like, wow, this actually looks a lot better than it did on the daily. Perspective, all about perspective. All right, 3 minutes to go. I want to walk you through some of these earnings. So NVIDIA, let me get an update here. Up 31, up more than 6%. And hey, yesterday I was saying, I don't know about this one. It makes me a little nervous. It doesn't look as strong as it did in the prior quarter. Well, they came out, like I said earlier in the show, the EPS for NVIDIA, $2.70. Expectation was 209. So 270 versus 209. That's pretty big beat. How about, I don't want to just show you beats. There were misses. One in particular in the semi space, analog devices, expected to come in at 253. They came in at 249. So we have one semi, NVIDIA, that's absolutely exploding on really good earnings. And then you have ADI, which missed. And their reaction is flat. Actually, I take that back. They actually reported yesterday morning. So yesterday, this is the reaction. And you can see intraday, they went down a lot, but they ended up coming back. And this was a stock, by the way. Look at the difference between ADI and NVIDIA in terms of how they've performed. I'd say NVIDIA is the much stronger performer, right? Go back here to ADI. I mean, we're down from where we were a few months ago. So on a relative basis, ADI is going to be a relative laggard. They missed their earnings. NVIDIA is a relative winner, one of the strongest on a relative strength basis, and they blew earnings away. Relative strength is a really important aspect of trading and investing. You want to be in leaders that are in leading groups. So NVIDIA certainly qualifies, ADI does not. And you see the difference in how they've been performing. All right, couple more I want to show you here. How about Snowflake? Snowflake, 22 cents. versus 9 cents expected in terms of earnings. So that's like 1.5 times, more than double, or 2.5 times, I guess. But you can see the stock up 4%, $6, although this doesn't make sense. Showing a market opened. That's why. So yeah, I mean, Snowflake looking really good at this point. Let's go ahead and just pull the charts up here and just look at a couple more and then we'll wrap up. Autodesk, big beat. Stock is up 6%. Splunk, this was a big beat. 71 cents versus 42 cents expected. Right up here at breakout territory. Didn't open in breakout territory. I think this is a stock. We'll see what happens. This is a stock that potentially breaks out intraday and then fails to hold it. And if it does that, I'd be a little nervous in the short term. So if I was in Splunk, I think if it goes to a daily low, I would take my money and run. But if it breaks out, I mean, I'd give it a chance to run. But if you see it set a 52-week high and then it goes back and goes below today's low, I would be out of the stock. I don't like those kinds of false breakouts. But the numbers were really good for Splunk. Network appliance beat 115 versus 107. Stock is down even with that beat. And of course, this is not looking at guidance. I haven't looked to see what guidance, what happened there. And then this morning, those were last night after the bell. This morning, we had a couple. Toronto Dominion Bank missed 148 versus 152. So let's take a look at TD. And we're down a little bit. Not a lot, down 2%, but still down is down. Royal Bank of Canada, they beat 213 versus a $1.99 and trying to bounce off of the support area. It's going to be kind of important for a lot of banks. If you see them moving back down toward recent lows, they need to hold. I think banks are going to be a key aspect of the market as we go forward here. I don't think they have to be the leader. Then they're probably not going to be the leader with an inverted yield curve, but I want to see them hold key support levels. And so looking at something like RY, I think 87, 88 is pretty important level. NetEase reported this morning and absolutely crushed their earnings estimate, 191 versus 133. Congratulations, it's down 3.5%. That's how fickle and how crazy the market is. Again, maybe they warned. Coming up after the bell today, Intuit in the software space, Workday will report, Marvell Technology, Ulta Beauty. Let's look at that chart. It has not been pretty. That was the last earnings report. It rebounded all the way to fill the gap, and now it's starting to roll back over again. And we've seen a lot of retailers taking big hits. I don't know. I mean, Ulta has been a great company for a long time, and it's one of those that you kind of maybe give it an exception, but it's not trading very well. And if we go and we look at a relative strength chart, you will see Ulta relative to the specialty retailers down near its 52-week low. So my expectations here would be a little tempered. Wouldn't be expecting a whole lot. Ulta is expected to earn $5.87. Based on the chart, we'll see. Anyway, let's go take a look at the market, what's going on here. We've got the Dow down just a tad. It's actually recovered from futures. S&P up 0.25%. NASDAQ up 0.5%. That's not very strong compared to what it looked like it was going to do. NVIDIA is now up $20. Be careful of the big black candle or even a big red filled candle on NVIDIA. Let's just take a quick look at that chart. Yeah, I mean, if it were to come back down and finish back down near 450, that would not be a good look at all with the kind of volume we're going to see today. So keep that in mind. I do on this chart like the fact that NVIDIA pulled all the way back down, had a negative divergence, went to the 50, went even a little bit below the 50, right on the center line, reset, and now we're starting to turn higher with a breakout. That actually looks really good technically. So NVIDIA, unless proven otherwise, certainly continues to carry the leadership torch for the semiconductor group. Anyway, that is going to be it for me today. I really appreciate you tuning in. If you're new to the YouTube stream or anybody who's watching us, through this live stream, please be sure to like the video and subscribe to our channel. Turn on your notifications and make sure you receive all the latest free events that we do. If your notifications are turned on and you're subscribed to our channel, you will be notified when we do a free event. So anyhow, again, thank you all so much. Have a great day. I'll be back next Tuesday for our next Trading Places Live. And for members, later today, actually it'll start at 5:30, will be our draft for our 3 portfolios, putting 10 equal weighted stocks in each of those 3 portfolios. Have a great day, everybody. Happy trading.